Hi, and welcome. Thank you for joining us for our webinar today. We're going to talk about wrap loans and how they work. And we are joined today by Jim Ingersoll. How are you doing today, Jim?
I'm good, Larissa, because I'm hanging out with you. You're becoming one of my favorite persons in the self-directed IRA world. So thanks for having me.
Thank you. Thanks for joining us. I'm excited to hear about it, and I know we're going to have a lot of questions. So I would just like to remind people before we get started that you have the opportunity to type your questions into the question box there. Everybody does stay muted, but we will get to your questions. So feel free to type them in as we go, and we'll answer them as I see them. My name is Larissa Greene. I'm with Advanta IRA, and I'm going to be your host for today before we turn it over to Jim, and then we'll talk just a little bit about self-directed IRAs at the end of the session. My contact information is here, so if you do have questions about self-directed IRAs and maybe you're not comfortable asking them on the webinar, please feel free to reach out to me. This session today is being recorded, and you will receive the link to the recording as soon as it's available. And then you also have the opportunity to download the slides, so I would encourage you to do so. Please keep in mind that Advanta IRA does not give tax, legal, or investment advice. Everything that we talk about today is for educational purposes only, and we encourage you to reach out to your attorney, your accountant, or financial advisor before entering into any type of investment. So I'm going to turn it right over to Jim because I know we're anxious to hear about wrap loans and get your questions answered as well. Take it away.
Thanks, Larissa. It is so nice to do this with you, Larissa. Like, you're one of the people that I connected with really fast. I don't connect with people as fast as I did with you. But Cheryl and I just like fell in love with you guys and your family and all that you've got going on. And I've heard reports as recently as today about people that just switched over to Advanta and really great feedback. So I know it's going really well. Hey, thanks for saying hello, everybody in the chat too. Tell us in the chat, like what city and state you're joining me from today so I can get a feel for where you guys are tuning in from would be awesome. If we've never met, my name's Jim Ingersoll. I would love to meet you in person someday. I had the pleasure of seeing Larissa a couple weeks ago in Tampa at Dealmaker Clearwater, at Dealmaker Tampa. I had that backwards. And it was so nice to see you. You can see some of our core values of our community there, which are integrity, generosity, collaboration, and abundance mindset. All of those are so important. But we got a diverse group from all over the place. And it's so good to see all of you guys, of course. Here is my contact information. Here's a new one, Larissa, I started using this year when Cheryl reminded me a couple months ago. I've now been investing 20 years, full time. So 20 years ago, I left corporate America with a measly little 401k, by the way. You know, I was doing my 3 and 3 through I did 20 years in corporate America before I left. And I didn't have a very big 401k, but Cheryl reminded me it was in January of this year that I hit that 20 years. It goes really fast. Oh my gosh, it goes so fast. There's my email. You're always welcome to reach out. We got, good one. Yay. I mean, we got so many awesome people. Tiffany, it's so good to see you on here as well. I'm glad we were emailing earlier this week. So many of you guys have been to or are coming to Dealmaker, and look forward to seeing you in person in 3 weeks from today, actually. And by the way, if you've never met Larissa in person, I would definitely put that on your bucket list at the very top. And you can do that 3 weeks from today at Dealmaker. Just a beautiful person inside and out. I want to talk today about wrap lending, and the timing is like perfect because this morning I was sending out my mailbox money. We always do that around the 1st, and I'm a couple days later than normal. But this morning, Cheryl and I just wrote out lots of checks that we're sending out to all the passive investors that do wrap lending with me. I've been doing wrap lending for about 3 years. I started doing it in my self-directed IRAs, Roth, HSA, whatever you've got. Solo 401k is an amazing place to do it from. And we've been doing it for about 3 years. Last year, I added in a second source of capital, which is an LLC from a rental I sold. So we sold a rental and started doing more lending. And I can see as how this lending is very, very contagious for sure, because the returns when you're wrapping are very high. And if you just like passive investing, then you might be a great co-lender. So I'm going to talk today about what a wrapped loan is, how it works, how it's different than private money lending. I've done some private money lending on and off for 10 years. How wrapped loans can be used to grow smaller accounts, which is a huge benefit to wrap lending, in my opinion, because so many people will open up like an HSA with that minimum contribution, and then they feel totally stuck. They don't know what to do with it. You know, $5, $10, $15,000 doesn't buy much real estate, right? Not without leverage anyways, and that's what we'll talk about today. We'll talk about why this strategy creates tremendous wealth building potential and some of the returns. And just to reiterate Larissa's awesome point of her nor I are CPAs, tax accountants, or any of that. So I'm going to tell you, I'm going to actually give you an actual case study, and that is a wrap loan where we earned 42%. But just because I earned 42% doesn't mean that you will on every loan. So always do your own due diligence and always talk to your tax and professional advisors, of course. That's what makes it all happen. But I'll tell you what, who would like to learn how to earn 20+% on your self-directed IRAs? I mean, who does that appeal to? And so many of us just have money sitting in self-directed IRAs and you don't quite know how to start. Now, hopefully I'll help you overcome some of those roadblocks today. So it's going to be really good. So let's talk about it. Wrap lending is leveraged lending, first of all. One of my favorite things about real estate, Larissa, is leverage. I love it. So like when Cheryl and I started building our rental portfolio, I realized at the beginning that I could just put 20% down and buy a house. That's leverage. As I became a better deal maker myself, I realized I really don't need that much money. If I find a really good deal with a lot of equity and some good cash flow, I might be able to do it for very little of my own money, and that's even higher leverage. Because you do value add, right? You buy a fixer-upper, and then you go, and it becomes worth more when you're done. I'm working on another duplex right now. I still love my rental property. And the duplex needs a lot of work, probably close to $100,000 of rehab. And then we're going to increase the value and increase the rents, and I'll go into permanent financing. What people don't realize is the same thing works for lending. For a lot of times, myself included, didn't realize how, I don't want to say how easy it is to do wrap lending, but there's just a few little points you've got to make. And going back to like some of the people that really helped me with this are Lucy Boniford, Dyke's daughter. She's a gem, just a wonderful person. And I would hear Dykes and Dorsey talk about this stuff. And there was just a couple of missing points on my own, like educational radar to connecting this whole strategy and making it work. Hopefully you'll get those today and you'll be ready to roll with it. But a wrap loan is one person, the wrap lender, who originates the loan. Like I said, this morning I was writing out all the mailbox money to my co-lenders, so the timing was perfect. And in this case, I'm the more active lender. The two lenders, one is very passive, one is pretty active, and not active enough necessarily to fall into UBIT and things like that, but you can talk to Larissa about those details. But you do have to originate a loan and you have to be able to service it. So you need a borrower, you need to do your due diligence, your underwriting, you got to originate the loan and you've got to service it. That's what the wrap lender will do. But they're going to leverage with somebody else's money. Think of it like when you're buying a rental and you're using OPM, other people's money, or as we like to say, OPI, Larissa, other people's IRAs. Of course. Right? So it's good. And so I will do that a lot. I wrote checks this morning to multiple different custodians. Okay. So like, this is just what I do. And so somebody else will come in with a larger amount of money and do less work. I'll come in with less money and do more work. and we leverage that together to make a loan. That's how we do it. Let me show you how it works. Typically, we're doing short-term investor loans, which is rate and points. I'm not a hard money lender, so I'm not charging like 15 and 5 or something like that. I love all those guys. I have so many friends that are doing high points, high interest. But as a regular private money lender, I might be like 10 and 3. That's what I do a lot. So I do a lot of lending at 10 and 3. So that means 10% interest only, monthly payments. I don't do interest accruing. I really believe in the pain of the payment. Like, I want people paying me every month, so they want to pay me off and return my capital. And then we'll do like 3 points a lot of times. Sometimes I'll adjust that down a little or up a little, depending on who I'm working with. So as a rep lender, I'm going to structure a loan to create an ROI of 20 to 50%. Who likes those numbers? I mean, don't we all? You know, Larissa, I was thinking about this because in most rooms and on most Zooms, I can't talk about numbers this big because it freaks people out. But in your world, like in your advanced investor world, like, we just normalize this stuff, right? Mm-hmm. It's okay. Is it all right?
Yeah.
So the lender, the rep lender is going to lend a smaller amount than the co-lender. In most cases, when I'm doing these, I am the rep lender, and I will lend a smaller amount than my co-lender. Sometimes I'll do 50-50, but a lot of time 50%, 50%. So if it was like a $200,000 loan, I might do 100K and my co-lender might do 100K. But more times than not, if it's a $200,000 loan, I might be 25,000 and my co-lender might be 175,000. That allows me to create more loans over a longer period of time. The co-lender will, or the rep lender will also interest at the rate charged to the borrower, like I said, like 10%, and will typically keep the points that are created. So let me show you some more about how this sort of works. The co-lender, again, will lend the majority of the capital and lend at a lower rate. Now, you might be thinking, like, I was just talking about 50% returns, and now I'm talking about 7 to 9% returns. What is the difference between those numbers besides, you know, a big gap, right? The difference is being passive, mailbox money, or being the one who really orchestrates the entire lending operation. So a co-lender will lend more at a lower rate, but is very, very passive and really is all about mailbox money. Or nowadays, it's even ACH money. It just drops in. That's how all my borrowers pay me. They all pay online. Most of them do auto payment. So it works out really well. So that's kind of the difference. You're going to hear more about this as we go. I've got a case study coming up in a few minutes. So if you have $25,000 in your HSA or your Roth or wherever it's at, and that's a low amount to get going in real estate. But let's say you find an incredibly cheap fixer-upper house. I don't even know where you can buy a $25,000 house anymore. Maybe a mobile home in Gary, Indiana, or somewhere like that, where I do lend. I do like that market, but it's very cheap. Mississippi is another, parts of Ohio and Indiana. Let's say you find some way to do a $25,000 loan, and you're going to do 10% with 2 points for 6 months. So if you do that as a regular private money lender with no leverage, no other person coming into this loan with you, you're doing it all on your own, solo, you're going to earn 2 points on the 25 grand. That's $500. And you're going to earn 6 months of interest at 10%. That's $1,250. And you'll make a whopping $1,750. That's it, because you have no leverage, no spread on anything, no points on a big loan. You only get points on this tiny little loan, and you're unlikely to do that on a house, maybe a used car nowadays. But what if you took that same $25,000 and you worked with a co-lender and you then originated on a $150,000 asset, like a house, like a single family house or something like that. And now you're controlling a $150,000 note or loan instead of $25,000. So you're going to earn interest on the full amount of 150 minus what you pay the co-lender every month, because you keep the spread on that. And then you collect the points on the entire loan. So you get 2 points on 150,000 instead of 2 points on 50,000. So your money works bigger with the same terms. The borrower paid you the same amount, 10%, 2 points. The difference is the size of the loan and doing it alone versus having a co-lender help you get through it. And if you do that on a wrap, you're going to make about $5,000, roughly, a little more. And that's against your $25,000 investment. That's why the ROI is so high. But if you did it on your own on a $25,000 loan, you're only going to make 10% and 2 points, which is $1,750. See why you want to do leverage. I love leverage. It doesn't matter if I'm buying a rental property like the duplex I'm working on now or structuring loans. And I guess, I didn't tell you guys this, but before I went into real estate 20 years ago, I was an engineer. So I've always loved like the architecting of a deal or the structuring of a deal. I just love it. This is really great news for small dollar IRAs if you can find a way to leverage. You could also buy rentals if you wanted to do like a joint venture. I've done that as well, but I really love the lending model. And it's also really good news for uninvested balances, because we know there is literally billions of dollars of tax-free money just sitting in accounts being eroded away by inflation. And today, by the way, you can be glad all that money is not sitting in the stock market, because it's taking a bit of a beating this week, if you didn't look. Personally, I'm glad I don't have anything in the stock market. So if you've got a small dollar IRA, you can learn to leverage and you can do your own wrap loans. If you've got larger balances that are just sitting and you like being passive and you really enjoy mailbox money, maybe you want to come in as a co-lender for somebody else doing leveraged lending like this, and you can earn your 7 to 9%. Nothing wrong with that. Keep in mind, rule of 72. You guys know this rule of 72, right? Tell me in the chat box you know it. So if you're earning say 8%, 72 divided by 8 means you're going to double your money how often? Every 9 years, right? So that's nothing wrong with that. I have a lot of co-lenders that are really happy with 8.5%, 8%, 7%, 9%, whatever it is. However, if you're going to do all the work, you're going to find the borrower, you're going to do the underwriting, you're going to originate the loan, service it from beginning to end, then you're going to earn 20+%. And Larissa, I don't know if you remember Jack Shea. He was sort of down in your area, right?
Yes, absolutely.
Man, now you know I go back a ways. Jack used to challenge us to double our IRA every 1 to 2 years. Did he ever tell you that?
No, I didn't know that.
He used to really push us to like double our IRA like every couple of years. And you can't do that easily on your own without really high rates of return. But you think about it, like if you want to double your IRA every 2 years, you've got to earn a 36% return, okay? And so I'm just saying the way you structure and invest matters. So I'm going to show you a crazy example, okay? I'm going to say that you learn to structure, you find great borrowers with good collateral, you have a team that you feel really good about with your loan docs. And I'm not really talking much about due diligence today and loan docs, but believe me, it is absolutely critical. I want you to get like the higher level 5,000 foot version of why wraps work and how they grow your IRA. So let's say you've got a $20,000 HSA or Roth or ESA. College isn't getting any cheaper. And you start doing these loans, and at first you might be a little skeptical that you can earn a 45% return. I'm going to show you an example of 42 in a few minutes. But all of a sudden you start clicking them out and you're earning 45%. Just based on compounding, that's going to, in 5 years, grow to over $100,000. But let's say you don't do quite as good. Let's say you do 30%. And you do that for 5 years, and you're starting with a rollover 401k from corporate America that had $100,000 in it. you quit your job, lost your job, whatever, went out on your own, and you moved that money to Advanta with Larissa. So you got 100,000 sitting there, and you start doing wrap loans, and you start enjoying being the bank, and you earn 30%. You do that for 5 years, and you're up to $371,000. That's why it matters how you structure. Okay. All right. I do have two ebooks I wrote last year on this topic. Really, the one that is in tune with us today is the Dealmaker Wrap Lending. And I want to give that to you because it gives more detail than I'm going to give you today. The other one is more about raising private capital. I used both of these when we were at Dealmaker in Dallas last October, Larissa. But that one on wrap lending, I think just would be a good follow-up to today's webinar. So grab that QR code. All right, let's talk about how it works and who is who. I said one borrower. So one borrower is going to do a flip or maybe buy a rental property and needs a short-term loan. 6 to 9 months is pretty typical. 6 to 12 months for sure. I don't really like going longer than 12 months. Instead of just one lender, there's going to be two lenders, and one is going to be active and one is going to be passive. The active lender is going to structure the loan, do all the due diligence. They're going to originate it. They're going to service it. By servicing, I keep meaning like collecting monthly payments. Like I said, all my borrowers pay me online through a system. Most of them are on auto pay. And then you'll have a passive lender in with you for a larger amount of the loan, and they earn what I call mailbox money or ACH money. Either way is fine. One, you might be wondering, like, who's in first, who is in second, if you know how mortgage lending works. I'm going to tell you right now, one of the ways you protect your co-lender is you put them in first position. So they're in first, and then the wrap lender, which is me most of the time, will wrap around that, meaning I'm going to service the loan and take care of it from womb to tomb all the way through. So the co-lender is actually in first position. They have a higher position, less risk. By the way, their loan is reduced by whatever you invest in your loan is. So that protects them as well. So it's structured returns. Everything's secured by real estate. You're going to have promissory note, deed of trust or mortgage, depending what state you're in, and rent, transfers and all that good stuff, personal guarantees, all that stuff that I'm not getting into today. That's a whole nother webinar, is all in place. And so it's structured returns, everything's secured. Why do self-directed IRA investors love this? Well, a wrap loan lets you originate a large loan, like $100,000, $200,000, $300,000 with a small amount of money. That's called leverage. And you're going to earn money on the difference from the two rates every month plus the points. So if you are collecting 10 or 12% from your borrower and you're paying 7 to 9% to your co-lender, there's a range there. There's a gap, right? And that gap is what's going to create monthly cash flow for you. Typically, it'll probably, well, depending how your loan gets structured, maybe $300 to $500 a month. And then on top of that, the co-lender is also going to keep the points. So whatever points you can charge. So if you have a $200,000 loan and you charge 3 points, that's $6,000 on top of that monthly cash flow. So there's multiple streams of income on every loan. So again, I just want to keep reiterating this because it's a little bit tricky to wrap your mind around. Okay, wrap. The co-lender provides the base capital at a little bit lower rate, 7 to 9% is what I've been paying out most of the time. And the wrap lender is going to add a smaller amount of capital into the loan, separate loan. But without the wrap lender, there is no loan because the wrap lender has the borrower, has the lending opportunity, does all the due diligence on the borrower and on the asset itself. So he's checking comps and location and condition and going through the repair budget and things like that provided, does all the underwriting, structures the deal, originates it, services it. And then they're going to use all of these funds. Typically, your borrower is going to do a flip or a rental. Again, you always want to have an attorney do all your documents for lending. This is really important. It's so important. So you got to have ironclad lending documentation. I work a lot with Jeff Watson, does all of mine. Some of you know Jeff. But this could be, like I said, the note, the mortgage, the deed of trust. PG is personal guarantee, and it's got to be right. It's really important. I mentioned earlier the rent assignment and some others. Those are really important things. It's how you manage your risk, whether you're private money lending or wrap lending, both. So the co-lender funds the majority of the loan. The wrap lender adds some capital in, and they both make great mailbox money. Let me give you an example. Let's say somebody comes to you and needs a loan for $300,000. The ARV, meaning the after repair value, is $425,000, and you don't have $300,000 in your IRA. But you'd like to do the loan. You have $100,000 sitting there because you just transferred it to Advanta from your old 401k, and you're not sure what to do with it. But now you've got this opportunity. You're just $200,000 short. So now you go out and you network, because we say your network is your net worth, and you find somebody you can work with on this loan that's got another Advanta account for $200,000, and they're going to do this loan with you at 8.5%. Now you can take your $100,000 and charge 10% to the borrower in 3 points, and you get those 3 points right at closing. So you get that as soon as the property is closed. So you get interest income as the wrap lender. You get that gap between what you pay and what you collect every month. So you get monthly cash flow. You get origination points up front, which I love. And you get to leverage other people's capital, or OPI, like I said, other people's IRAs. Same thing. Here's another example. Let's say that you've only got $30,000. It's in an HSA, ESA, brand new account you just funded, whatever it is. And you've got an opportunity to do a $300,000 loan, but you're $270,000 short. So you could bring in a co-lender for the $270,000. And in this case, you're going to collect 3 points. That's $9,000 against your $30,000 loan. That's up front, by the way, is really nice. So you're going to earn points, and you're going to earn monthly spread. I am going to skip right to here. All right, I want to go through this one, because this is an actual case study. Do you guys like case studies? All right, I see all your questions coming in, so we'll grab those in just a couple of minutes. I'll be done. I want to go through this one. This one is actually on King Street in a little town in North Carolina near the coast called Belhaven, North Carolina. I did not buy this house, but I would have rather have bought it than lend on it, to be honest, because it was a good deal. And when you find a good deal, you'll always attract capital. So somebody that I know purchased this house for $145,000. He didn't really need much fix up. He didn't want to fix it up because he lives outside of this market a little ways. So he only needed $150,000. So he was just going to like clean it up, clean it out, get all the old furniture out, clean up the yard a little bit, and list it. We call that a wholesale deal. Okay. You guys ever done a wholesale deal? When you get them, they're pretty nice because you don't have to do very much work on your flip. So we closed on this in September and did a $150,000 loan. The comps look good. The actual tax assessment on this property is $300,000. So why does this work? The borrower flips, the co-lender earns mailbox money at 8.5% with me on this one. The wrap lender generates a very high return in exchange for the origination, the underwriting, due diligence, servicing, and getting all the loan docs. Okay, let me show you how this works out. So this little brick house in North Carolina had a total loan of $150,000, and it went very close to 6 months. I just got paid back on this less than 2 weeks ago. The co-lender position on this was $125,000. This was somebody's solo 401k. It's a great account, isn't it, Larissa? I love solo 401ks, don't you guys? If you don't know what they are, ask Larissa. It's an amazing account. So this was actually, I don't know if she's on, but she's a wonderful dermatologist in Texas, was my co-lender on this. Just a wonderful person to work with. And she put up $125,000 as my co-lender in first position. 8.5%, no points. Okay. And I told you earlier, I normally do 10 and 3. This was a very good friend of mine, so I cut him to 2 points. It's an actual deal. So, anyways, in my IRA, put up $25,000, making the total loan 150. You guys like tracking with this? The borrower, a friend of mine, paid me as a wrap lender 10%, 2 points. I paid out 8.5% to the solo 401k. This deal works out to a 42% ROI. Let me show you. So there's a couple different ways you get paid as a wrap lender. The first thing is, like I keep saying, you gotta service the loan. So you're gonna collect every month. If you collect 10% on $150,000, that's $15,000 a year. But this was only 6 months, so I collected $7,500. I want to make sure you guys understand a little bit of the math. And the interest paid to the co-lender in this case was 8.5%. If it went 12 months, I would be paying this solo 401k $10,625 a year. In this case, it went 6 months, so I paid out $5,300. You guys see the spread there is just over $2,000 from $7,500 to $5,300. Does that make sense? So that's what my IRA made on this as the wrap lender. Okay, so that's just the cash flow piece. But the actual spread is actually going to be higher because you've also got points. And I said this was $150,000 loan, so 2 points is $3,000, right? I would have been $4,500 if I had charged 3 points, and those 2 points come back to my IRA. Okay, so my IRA as the co-lender or as the wrap lender earned $2187.50 in 6 months of interest. That's the difference between what I collect and what I pay to the solo 401k in this case. This is actually great, Larissa, because it's 2 IRAs both making money, positive income. And so that works out to roughly $51.8750. Okay. The wrap lender's ROI is really high. In that case, that's mine. It's really high because it's a small amount invested. Again, it's leveraged. So it made $51.8750 against $25,000. So that's roughly a 20% return. But we did it in 6 months, so it's actually double that. That's how I get back to my 42%. It makes sense, guys? Okay, let's go through it again. Again, this is basically flip funding for a friend of mine who bought this house in Belhaven, North Carolina, a 6-month term, $150,000 loan against a tax assessment of $300K. The lead lender, the co-lender, I should say, came in at 125, was a solo 401k, 8.5%, no points. I brought the deal to the table. As the wrap lender, I invested my loan of $25,000 in second position at 10 and 2. Okay, so the total ROI on that is 42%. All right, so let's talk about it. How do you start? Because some of you guys are like, this sort of resonates. You like the idea of being a bank that works really good out of a small dollar IRA or just uninvested funds that are sitting. And so you might be wondering how to get started. Well, there's 2 positions you can start in. You can take your pick. You could be the wrap lender like I am, and structure the deal. You're going to like be the orchestra leader because you've got to have a borrower, meaning you got to go where borrowers are at, which is typically meetups and things like that. Then you've got to be able to do the due diligence. Honolulu sounds beautiful to me. You got to do the underwriting. You got to identify and network to find a co-lender. You got to structure the wrap loan. You got to be able to generate amazing ironclad loan docs. And then you've got to be able to service the loan. And then monthly, like I did this morning, you've got to send out your own mailbox money. So the wrap lender is higher returns, but also a good bit more work, okay, which I'm fine doing. I've got a good network. I don't mind doing the few hours of work every week. I'll go back to rule of 72. But if you've got no experience and you've got funds just sitting, why not start as a co-lender and earn your 8.5%? Larissa, I've had quite a few people start there, like thinking of Dee Hammond in Detroit. She started off as a co-lender, and we worked through like 2 to 3 loans together, and then she ditched me. And she went up the ladder to become the actual ramp lender. And by the way, it made me happy. It's a great way to learn because you're leveraging somebody else's network, you're leveraging somebody else's experience so that you can learn. See, both sides can actually leverage. Leverage isn't just about money, it's about talent and experience and other things. So you could identify a ramp lender. Once you do that, all you've got to do is confirm your loan docs, wire, and enjoy some mailbox money till 6 months or 12 months later when the thing closes. So you can take your pick. If you're experienced, you have deal flow, you have a network, you have people in your life that have great deals with good assets, jump right into being a lender and start leveraging to create an amazing return. Or if you've got no experience, no network, you've never done anything like this, then find somebody who is a rep lender and co-lend with them. Take your pick. All right, it's a good place for questions.
Mm-hmm. Yeah, so I'll read them out to you, Jim. So how about title search, paying the attorney and closing costs? How does that affect the loan?
The borrower pays for all of that. The borrower pays for all of it. By the way, you get a lender's title policy, and you also get named on the homeowner's insurance. But all of the fees, including the ironclad loan docs, the borrower pays for that. They can also pay for your wire fees. So I didn't really talk about fees. I don't do a lot of fees, but boy, hard money lenders, they know how to set up fees to really increase their returns. So I'm not typically a fee hungry person, but I will get all my expenses covered.
Mm-hmm. Yeah, that's good information. And then somebody did also ask about training for wrap lending. So I'm actually going to go back really quickly to the slide with the QR code for the books. So Jim mentioned these 2 books, and you guys can scan the QR code for that. So I'll leave it up as we go through questions. So the next
I'll give you a book also for this one. A friend of mine, Chuck Glover, wrote a book. It's called The $5,000 Millionaire. And Chuck was 69 and a half when he came to Dealmaker several years ago, trying to figure out if he had any options this late in life to get started. And he spoke to Mary Hart, who's just a gem of a person. And between Mary and Dorsey Bodiford, they helped him get going at 69. And 5 years later, life is completely different. And now he's written a book. It's on Amazon called The $5,000 Millionaire. It's a great book. It'll help you understand rep lending.
Awesome. Thanks, Jim. We lend privately in first lien positions on real estate with LTV up to 50%. Oh, hold on. Sorry, it's jumping around here. Preferably cash flowing single family rentals. We'll consider co-investments. Let's see. Oh, I'm sorry. That's you guys. Thank you for posting your interest, but let's keep it to questions if we could, please.
Networking's always good, so yeah. It's all right.
Are there costs, the wrap lender, other than investing dollars for lending? And you kind of mentioned that you really just cover your costs and kind of leave the points and fees out there.
Pass everything to the borrower.
Mm-hmm. Could you tell us more about the Rule of 72, Jim, or maybe just review it again for us really quickly?
I mentioned, Larissa, I went through engineering school, so I took like all this crazy calculus, all this advanced stuff that is irrelevant completely. And you know what they never taught me in engineering school? Compound interest in the Rule of 72. It's like, what is wrong with colleges, right? And I went to a good school in Rochester called RIT. It's not that it isn't a good school, but I didn't learn this until like the second 20 years of my life when I started going to Tampa. And the Rule of 72 is really easy. All of us can do this math. It's just You take your annual return and divide it by 72. So if you earn 12%, 72 divided by 12 is what? 6. It means you're going to double your money every 6 years. So it's just like napkin math, which I really like. If you earn 2%, like in a CD, it's going to take you 36 years to double your money. Do you see the difference between a CD and investing your self-directed IRA? So there's big swings, and if you could earn 36%, you're going to make Jack Shea really happy, and you'll be doubling every 2 years. So the difference between 2, 12, and 36 is immense. And the way that you learn to use your money and make your money work for you instead of you working for money makes a difference big time. I wish I knew this before I left corporate America, Larissa, but I didn't.
Absolutely, Jim. Another question that popped up, does the co-lender additionally cover the rehabbing costs? And I think that depends, but tell us what you normally do, Jim.
Yes. Okay. So a lot of times I'll cover rehab costs as long as I can hit the LTV I'm really looking for. And then, that's a whole nother discussion on how you're going to do draws and things like that. So this topic goes deeper and deeper.
Yeah,
but yes,
absolutely.
we will a lot of times cover rehab costs.
Can the documents be prepared by a title company or must it be done by an attorney? I will tell you from the IRA standpoint, we leave that up to you. But Jim, what do you typically do?
No, I agree on that. I'll leave it up to you as well. Personally, I am really picky on my loan docs. So I want them, like, that's how I sleep well at night. If my loan docs are good and something happens, God forbid, if a borrower were to pass away or something, like you got to have good docs. So it's really important. I can't emphasize that enough.
Absolutely. And I want to mention really quickly too, that you mentioned Jeff Watson. He actually did a webinar with us back in October on due diligence and private lending. So if you're not sure where to get started in your due diligence, it was a wonderful webinar. It is posted on our YouTube channel. So you can go back to the October post and look for due diligence with Jeff Watson. It was a great webinar. It really helped people to understand, what kind of due diligence they need to do. But I would also lean on the recommendation that Jim gave for partnering with somebody more experienced. I see that a lot in investment groups. I actually help run an investment group every week, and we hear a lot of people talk about how they learn from their peers. So working with people, partnering with people in their community to learn more. I actually had somebody in my investment group a few weeks in a row say, hey, I want to be the co-lender on a wrap loan so that I can learn, just like you said, Jen. So yeah, he put it out there. Hey, I want to be, in the co-lender position so I can learn more about wrap loans. So I think that's a wonderful way to do it. I've partnered myself that way to learn more about investments. So
love that. That's another thing I didn't get taught in engineering school was the power of your network and the value of relationships. And like just the fact that Jim Rohn was right when he said you become the average of the 5 people you're spending time with.
Absolutely. Someone asked, what's the minimum investment amount for a self-directed IRA? There is no minimum. And I would say for wrap loans, there's probably no minimum either. Jim's talking about, 25,000, 30,000 in the wrap position, but I've seen, being with Advanta IRA, I've seen much less. And maybe sometimes those are smaller loans overall, but not always. And so, we've seen wrap loans that have all kinds of second position loans. So somebody might bring 5 or 10,000 to the table for a loan. And so there isn't a minimum as far as an IRA is concerned. Jim, maybe you could give us the least amount you've brought to the table for a wrap loan.
Probably 15 or 10 for me. I don't know. John Heyer seems to think that with the self-directed IRA, you should be close to 10%. I'm not certain exactly what his basis for that is, but John is somebody that I happen to love and really respect a lot. So it's not a bad guideline.
Absolutely. What's the process and expenses involved in origination and servicing a wrap?
There's not really any expense in originating. It's just time, because all of your expenses are going to get sent over to your borrower. So whatever you've got for like lender title policy and that kind of stuff, they pay for all of that. They pay for everything. But it does take your time, you know. So
absolutely. And kind of as we go through these questions, actually, I want to go to the deal maker slide because Jim does have a class coming up March 24th to the 26th. We're going to learn a lot at that class. So I would encourage you to check it out. As we go through the rest of the questions here, I wanted to put this QR code on the screen for you. Yeah, absolutely.
I've got one other link I want to share with people. They'll have to write it down though, or put it in the box because I have this AI lending studio I've been working on for a while now, Larissa. And in that, I've got my underwriting checklist in PDF format, but I've also got a due diligence guide, a underwriting checklist, both in GPT format as well. And then I've created this thing called LendPro GPT. I've been working on it for a while. And LendPro GPT does the math of your wrap lending. I created it for myself so I could like shortcut the math. And so like you can put your deal structure into LendPro GPT and reasonably fast, it'll tell you what your expected return would be if everything goes as planned. And that is elitedealmakers.com/AI.
Oh, perfect. Okay. I will type that into the question box in just a minute. But I had another question pop up. Do you use a professional servicer?
I service my own. So to answer that, no. I think if you were going longer term, like I have used servicers on notes, but on loans that I'm originating, I'm servicing them myself.
Okay, perfect.
You got to think that through a little bit because like if you have multiple loans and you're asking everyone to pay you on a Cash App or Venmo or PayPal, then you got to think through how you're going to keep track of all that. And so as you scale and as you grow a little bit, systems become very important. So I do mine through a system, but like if you're only going to do one or two, you might be okay that way. But if you're going to scale up, then you're going to need something a little better.
Mm-hmm. We had a few people post that they wanted to ask how they partner with you. I would just tell you that Jim did share his email address. You can always reach out to him and find out more about his networking. There's a lot of networking events with deal makers as well. So depending on where you are in the country, look up deal makers. It's elitedealmakers.com and you can find if there's a meeting near you as well.
Thank you.
Is there UBIT if you are the wrap lender?
I'm going to let you take that one, Larissa.
So I can't give tax advice, but it is my understanding that there is not going to be UBIT. You're not really, Jim mentioned leveraging the IRA, but I think really more specifically, he's leveraging the ability to use the IRA. The IRA is not actually incurring any leverage here. So there is a first position loan with a third-party borrower, let's say, and then his IRA or personal funds would be in second position. So it's my understanding that UBIT would not apply.
Yeah, I think that's a good point. I just want to go back to thinking about your own IRA real quick, because it was just 3 months ago or a couple months ago, we were all setting goals for this year, 2026. And here we are in March already, like the year is roaring by. And I just want you guys to think about the goals that you set and how you're coming against those. But very few people ever set a goal for their own IRA. And I would like to encourage you guys to consider that. Like set a growth goal for your own IRA, not just your contributions, but your investment growth as well. It's something nobody ever talks about, Larissa. Thanks.
Mm-hmm. Yeah, absolutely. Can the wrap lender only use IRA funds or can you use cash? I think, of course, you could use personal cash too. Jim was just illustrating the point that sometimes if you have smaller amounts in your IRA, you're starting with a contribution or you have funds left over or coming in from an investment you already have, those funds don't have to sit idle. So once you have enough that you feel is appropriate for the wrap position, you could do it, but it doesn't have to be IRA funds, of course. It's just a neat way.
I do like half and half. So I've got my IRA money always working, but then I'll also loan out of an LLC part of the time.
A question popped up. Yeah, a question popped up. Does this only work with first position loans? I'll let you kind of explain why it works in a specific structure, Jim.
Yeah, really it does, because you have a first and a second. So if you're going to try to do a wrap loan behind another first, then you're going to end, if you're the wrap lender, you're going to end up in third position. Personally, I don't like investing in second position. I definitely don't want to be in third. I'll do a second like on a wrap, but as a general, I'm personally not a huge fan of second position. Good
So
question.
someone asked, does this work in a self-directed solo 401k? One of Jim's examples was with a solo 401k. So absolutely, you can do it with a solo 401k as well.
What an amazing account that is, Larissa. I love that account.
Yeah, absolutely. Yeah, and if you guys are interested in learning more about a solo 401k, since we mentioned it, we do have a webinar again in our archives on solo 401ks and the benefits to those accounts. Those are for the self-employed and with spouses as employees only. So equitable partners in the business and then spouses as employees. And they're great accounts. They have a lot of benefits. When you think about a 401k, they're basically a 401k directed towards those that do not have employees other than spouses. So it's a really cool account. If you're a nationwide lender, do you need an attorney in each state to review documents, or are you comfortable with an attorney?
Boy, it gets a little tricky because I'm lending in like half a dozen states, Larissa. I think I'd rather lend more at home in Virginia. Yeah, I think it's helpful to, unless you've got a really versatile lawyer who's able to draft something else. You know what I mean? Yes.
Have you ever sold a loan where you were the wrap lender, or do you always hold them until they're satisfied?
I do not sell mine. I know there's people that do that to get some of their capital back and all that, but I do not. I have no reason to sell it. I like the returns. Here's the other thing that happens, Larissa, because like I just did a check. Here's my check. I'll turn it this way so you can't see it, but it just came in the mail. That's for a closing we did Thursday of last week in Syracuse, New York, of all places. But what happens when you originate a brand new loan is you get a check like that in the mail from the lawyer for your points. And you know, if you're doing like a $300,000 loan and you get 3 points, that's a $9,000 check. We were just talking a minute ago about how much it takes to do your next loan. That's almost enough to do another loan, just like that.
Absolutely.
So
But
if you're starting with, say you're starting with a $10,000 ESA or HSA, whatever. You do a loan for like 300,000. Somebody else puts in the 290. You get a $9,000 check in the mail. You could actually turn around and do another loan, like right away. And then when you get that one, if it's similar, you could do it again. So you could start like building out a portfolio of loans. I love my rental portfolio, but I also love having a portfolio of loans. And so you can get there quicker than you might think.
Absolutely. I have one more question here, and then we'll talk really quickly about IRAs. If I own a sub-2 property in an LLC and want to sell it on a wrap, I become the wrap lender. Is that correct? The mortgage stays in place as first position.
That's a little bit different kind of wrap. There's two different kinds of wraps. I'm talking about wrap private lending, but you can also buy a house and sell it on a wrap, and their lending wraps around the first. I've done that quite a few times myself with seller financing in particular. Some people are doing it on sub-2 deals. You got to really be careful nowadays. But yes, you can do the other type of wrap where you sell with seller financing on a wrap.
So again, this webinar is brought to you by Advanta IRA, and we are a self-directed IRA custodian. We hold accounts. So you find the investment and we help you get them done in the name of the retirement account, and that's important. And so just a little bit about us, and then I'll go back to the QR code for elite deal makers at the end of this month. But we have been in business a little over 20 years. We have around 3.85 billion in assets under administration. And everybody that has an Advanta IRA account has a personalized individual account manager. That person is dedicated to work with them for their account for the life of the account. And that's important because many of you might be new to self-directed IRAs, and having a single point of contact that can help you with the investments you're making is very valuable. And most people are new to self-directed IRAs. A lot of times people will say to me, I want to come over and do this, but I'm really worried. Will you hold my hand through it? Because I've never had a self-directed IRA. And that's true for most people. And so we found the dedicated account manager system works really well in that case. We have other educational events all the time. And I mentioned a few of those. You can always email me if I mentioned something and you're not sure how to find it. Just email me and I'll make sure you get the link. I think we talked about solo 401ks. We did talk a little bit about UBIT. So we have a webinar on that as well. And then, of course, we have deadlines coming up. So if you guys are worried about your deadlines and your contributions and the amounts you can make, you can email me your questions, but I can also send you a link to a webinar I did on that topic. A self-directed IRA, very simply, is an IRA account that holds investments outside of the market that you choose. We don't have anything to sell you at all. We simply provide a service. So Jim talked a lot about wrap loans and how to make that money work for you. And so you can do that through a self-directed IRA, and we can help you. We open the account, we help you fund it, and that can be a rollover from an old employer plan, an IRA to IRA transfer, or again, simply an annual contribution. And this is a really cool time of year because you can contribute for last year as well as this year. So, Jim mentioned having, a little bit of funds in that account and what you should look to invest. And so you can put your 7,000 or 7,500 in now or more, depending on the type of account and your age, so that you can put that money to work for you right away. What types of accounts can be self-directed? I get this question a lot, so I have them listed here for you. But plans for individuals, very simply, traditional IRAs, Roth IRAs, and if you've inherited an IRA, you can also self-direct that. We hold plans for small businesses, solo 401ks, SEP IRAs, and simple IRAs. And then, of course, former employers' plans of any kind can be rolled over to an IRA account. Not listed up here, but can also be self-directed, HSAs and ESAs, so education savings accounts, and health savings accounts. So those can be self-directed as well. And, the contribution limits for those are going to be, something where you're like, okay, how do I put this money to work right away? A wrap loan might just be the way to do that. And again, you can contribute for last year and this year as well. Since we don't sell anything at all, we teach classes all the time about the different investments that you can make with a self-directed IRA. Instead of giving us a list of things you can do with a self-directed IRA, the IRS has simply instead said, this is what you can't do. And there's only 2 asset classes you can't hold. That's life insurance and collectibles. And there's only certain people up and down your lineal tree that you cannot transact with. And outside of that, just about the sky's the limit. If you guys are curious, you're not familiar with self-directed IRAs and the rules, again, I have a webinar all about the rules and how you can make them work for you when you're looking at doing different types of investments, including how partnering works with IRA accounts. I see somebody asked me for my contact information. So here it is again. You can reach me at the extension here, email, or use the QR code to reach my page with my information on it. You can certainly get a copy of the presentation slides today. You're going to get an email either later today or tomorrow with the link to the recording. And at that time, you can also request the slides. So you can click on my email address, simply request the slides, and I'll make sure to get them over to you. And with that, I don't see any other questions. I had a question on the fees. Again, you can email me, but I can send you the fee schedule, or you can go to advantaira.com, click on forms, and then click on fee schedule, and it's there for you. I'd be happy to discuss that with you. Yes, there is a transaction fee. So when you're making an investment, you have a transaction fee and an annual fee for your asset, or your investments can be based on total value. So if you're doing short-term lending, you can choose that option. And just a little tip, sometimes we see borrowers pass our fees down to, our lenders pass fees down to borrowers in order to recoup Advanta's fees as well. And sometimes people don't. They say, no, I charge points. I don't charge Advanta's fees to my borrower. Again, that's going to be completely up to you. I just went back to the Dealmakers QR code. So if you're interested in finding out more about the class, March 24th through the 26th. I'm really looking forward to it. And I hope that if you're going to be there, you come and meet me in person, because I love to meet people face to face. And I'm very excited about it. Jim, did you want to add anything else before we close?
No, I can't wait to see you again, Larissa. If you guys have never met Larissa in person, that needs to go on your goal list for this year for sure, whether it's in beautiful Clearwater or here in Richmond, somewhere along the way. Just a genuinely wonderful person who's super smart. But yeah, and my email is jim@elitedealmakers.com. If you sign up for that /lending, it'll take care of your question on co-lender as well, because you're going to get some emails or in the ebook. So I think we've given a lot there today, Larissa. I think it'll be great.
I think so too. Again, the recording will go out either later today or tomorrow. So if you want to review it or share it, you will have that link, and then feel free to email me for the slides. Thank you so much, everybody, for joining us today. Jim, thank you so much. I'm really looking forward to the class. It's going to be a lot of fun.
Good to see you again, Larissa. Have an awesome day.
Thanks, you too. Thanks, everybody.
Bye-bye, everybody.